Okay, I think we are live now, so it's time for me to say good morning or good afternoon to everyone and welcome you to our second of a series of webinars introducing the exposure draft general presentation and disclosures. So as you know, this is consultation document arising from the board's work on primary financial statements project, which was published in December last year. Just as a reminder, the original comment period was scheduled to close end of this month, but it has been extended until 30th of September to give you more time to consider the proposals in the light of pandemic we are facing currently. My name is Aida Vacenjak. I'm a technical staff here at the ISB, and I'm joined today by my colleagues Caroline Konings and Nick Barlow. Some participants may have watched our first webinar introducing the overall proposals in the project, and if you missed this, we have a recording available on our website. In today's webinar, we are going to discuss in more detail the proposals relating to subtotals in categories in the statement of profit or loss, and we're also going to cover proposed amendments to the statement of cash flows. And before we start, let's just look at a few housekeeping items. So just as a reminder, you can find the exposure draft and all the accompanying documents on our website. And also the slides we are using today, they will be available after the session together with the recording of this webinar. And I just want to thank you again for all of you joining us today and those of you who have sent us questions in advance. I also want to invite you to submit questions anytime during this webinar, and to ask a question, you can just type it into the question box on your screen and just press submit. What we will do is answer as many questions as possible after our presentation. And as always, just as a reminder that the views that you hear from us today are our own views and not necessarily those of the board or the IFRS Foundation. So what I will do now is hand over to Nick and Caroline. And Caroline, before we get into the detail of the subtotals and categories proposal for those, can you just remind us how these fit into the overall proposals in the exposure draft?
Thanks, Aida, and good morning, everyone. So as we discussed in our first webinar last time, where we provided an introduction to the proposals, the objective of this project is to improve how information is communicated in the financial statement, with a particular focus on information in the statement of profit or loss, or the income statement. And this next slide shows that the key proposals in our exposure draft each respond to strong messages that we received from users at the start of the project. And in response to those messages, the board is proposing 4 main groups of proposals, as shown on this slide. So first of all, we have proposals around subtotals in the statement of profit or loss and categories. Then we have proposals around disaggregation in the financial statement. Then we have proposals around management performance measures. And then finally, we're also proposing some targeted improvements to the statement of cash flows. And so today, we will really be focusing on that first set of proposals on the subtotals in the statement of profit or loss. And then we'll also touch on those proposed improvements to the statement of cash flows, which are more limited. And then the remaining topics, so the disaggregation and the management performance measures, we'll explore those in detail in future webinars. So let's get into today's main topic. As I said, that's subtotals in the statement of profit or loss. Now, before we get into the detail of the proposals, Nick, can you explain what the underlying issue is that these proposals aim to address?
Sure, of course. Thank you, Caroline. So as we discussed in the last webinar, today IS1 requires a presentation of a revenue line item and a profit or loss subtotal, but no specific subtotals in between. And this has led to diversity in the presentation and calculation of subtotals, even amongst entities in the same industry.
Now, we already discussed some of this diversity in the last webinar, but could you give us a bit more insight again into the research that the team did and what we found?
Of course. So to help us understand the current practice regarding presentation in addition to our outreach activities, we analyzed a sample of 100 entities reporting under IFRS in a variety of industries and jurisdictions. And we looked at the statements of profit or loss and found similarities in the labels of the subtotals presented, but quite a high degree of diversity in how those subtotals were calculated. So for example, 63 of the entities that we reviewed had an operating profit subtotal, but we observed at least 9 different definitions of how that operating profit was calculated. So in the charts on the slide, we can see examples of how those definitions differed. So for example, some entities included the share of profit or loss from associates and joint ventures in their operating profit, while others did not. Some included interest on defined benefit pension liabilities in operating profit. Again, others didn't. And as you can see in the chart on the right-hand side there, in almost a quarter of cases, it was unclear what the classification was.
Thanks. So now that we've covered the problem that these subtotals aim to address, let's talk about what the board is proposing specifically. So for those of you who listened to the first webinar, this example that's shown on the slide of the statement of profit or loss should be familiar to you. So it illustrates the 3 proposed subtotals, and those subtotals are operating profits and income and expenses from integral associates and joint ventures. And then the third subtotal is profit before financing and income tax. And then on the right-hand side of this illustration, you can also see the 4 supporting categories, which are operating, integral associates and joint ventures, investing, and financing. And so today what we'll be doing is we'll be looking more closely at how each of these categories is defined and what types of income and expenses would be classified in each of these categories. So our approach is that we'll start by explaining how this would look for a non-financial entity, which we refer to as the general model. And then we'll move on to talk about how we have adapted this general model to work for companies such as banks. So let's start with this example on a non-financial entity, and we'll work through this example from the bottom up, starting with the financing category and the profit before financing and income tax subtotal. So Nick, can you start by reminding us what is the objective of that profit before financing and income tax subtotal?
Of course, thanks, Carleen. So the objective of this subtotal, so the profit before financing and income tax, is to allow users to compare the financial performance of an entity independent of its financing decisions. And this is supported by the financing category, and it helps with this objective by communicating information about the income and expenses from the assets and liabilities that relate to the entity's financing.
So if we look at the slide on the financing category, so we can see on that slide that the board is proposing to include 3 types of income and expenses in that financing category. So first, there's income and expenses on liabilities arising from financing activities, then also interest income and expenses on other liabilities, and then finally, income and expenses from cash and cash equivalents. So let's have a look at each of these 3 in a bit more detail now.
Sure. So why don't we start with the main component of the financing category, which is shown on the left-hand side here, and that's income and expenses on liabilities arising from financing activities. So the board is proposing financing activities as a defined term, and it's proposing to add that to the definition to IAS 7 as well in relation to the term borrowing, and that's to help improve consistency on how the term is applied. Now, the definition included on the slide aims to capture what is in practice commonly referred to as borrowing. So the key elements are that it's a provision of a resource from one entity to another. It's for a period of time. There's an expectation that it will eventually be returned, and then the lender is compensated for the time value of money.
And could you give us some examples of activities that would meet that definition of financing activities?
Of course. So as I mentioned, these are items typically thought of as borrowing. So we're talking about things like loans, notes, bonds, mortgages. Would also include lease liabilities or trade payables that are negotiated with extended credit terms. So that all that means that the main expense here is expected to be interest expense. but there might be other types of income or expense because gains and losses might occur on these types of liabilities. So for example, if you had a loan that was renegotiated or if a liability was remeasured at fair value, these could result in gains or losses. And given that those are from financing activities, they would be included in the financing category.
Now, you didn't mention pension liabilities or provisions in that list, and I know these can also give rise to interest expenses. So what would happen with the interest on these types of liabilities?
Yeah, so that's a common question, and it's covered by the second item on this slide, and that's the interest expenses on other liabilities. So in addition to the interest on pension liabilities, it would include things like the unwinding of a discount on decommissioning liability, provisions for warranties, or deferred consideration on a business combination. Now, there's different views on how interest on other liabilities like this should be classified. For example, we talked about the defined benefit pension obligation and the interest on that. Some see this as a cost of providing the benefit to employees, and so they would think that that should go into the operating, while others believe it's an interest charge for paying those expenses at a later date, and therefore it's equivalent to financing. What the board concluded was that the best way to achieve greater consistency and address this issue was to have a common classification for these types of items for all entities. And so as most users treated these as expenses in financing, in their analysis, the board proposes that the interest expenses on liabilities that do not meet the definition of the financing activities be included in the financing category.
Okay, thanks. So as we can see in the slide, in addition to financing activities and then interest on liabilities that do not arise from financing activities, income and expenses from cash and cash equivalents are also classified in the financing category. Could you explain why that is?
Sure. So while the rest of what is classified in the financing category is income and expenses on liabilities, there's an exception here for cash and cash equivalents. And that's because many stakeholders see cash as a part of the entity's financing. Often cash management is interrelated with the decisions about debt and equity financing. For example, your excess cash could be used to pay down debt or to issue dividends. And again, there's many different views on what makes up this excess cash. And that's both because every entity requires some amount of working capital that might be considered operating, but also many consider different types of investments to be excess cash based on their liquidity. Now, given that IAS 7 already has a well understood definition of cash and equivalents, the board concluded that the overall objective of consistency in presentation would be achieved best by using this definition as a proxy for that excess cash.
Okay, so you mentioned that income and expenses on cash and cash equivalents are an exception because the financing category otherwise only includes income and expenses on liabilities. So does that mean that interest income on other assets, so other than cash and cash equivalents, would not be financing? So for example, what about interest from a significant financing component that's included in a contract with a customer under IFRS 15?
So that's right. Interest on assets such as receivables would not be included in the financing category. But in your specific example of IFRS 15, you could end up with advance payment terms that have a significant financing component, or effectively borrowing from your customer. And if that was the case, given its interest on a liability, that would be included in the financing category.
Okay, so now that we've talked about the different types of income and expenses that would be included in the financing category and the reasons behind that proposed classification, let's now look at the next category, which is the investing category. Nick, could you start by reminding everyone of the objective of this investing category?
Yes, so the objective of the investing category is to communicate the returns from assets that generate returns individually and largely independently of the entity's other resources. And that's because many users analyze these returns separately from the operations of the entity. Now, as with the financing category, the definition is important here, and the key item included in the investing category is termed income and expenses for investments, which the board has defined.
So with the previous section, the financing category, you highlighted some of the key components of the definition. Can you do the same thing here? So can you highlight what are the key components of the definition of income and expenses from investments?
Of course. So the first important point to note is that it's assets. And the definition will capture income and expenses coming from either financial assets like equity investments or bonds, or also non-financial assets like a investment property. The second part of the definition is that the returns are generated individually and largely independently of other resources. So that's going to scope out assets that interact with other assets and liabilities in an entity, such as property, plant, and equipment. It would also exclude groups of assets, such as in a CGU or a whole business that would consist of multiple assets and liabilities. So none of those would meet the definition.
Okay, so that was in terms of income. So the category would include things like interest on investments like bonds and dividends on equity investments, or, for example, rental income on an investment property. So I think that's clear for the income side. But what about any expenses on investments?
Yes, so on expenses on investments, there's two important points to note. And the first is that expenses on investments would capture losses. So, for example, an impairment loss or a disposal, or if share value was used as the relevant measurement basis, those losses would be included as well. Now, the second point is that the board is proposing to include in the investing category incremental expenses incurred generating the income and expenses from investments. So that's going to be expenses that the entity would not have incurred had those investments giving rise to the income and expenses from investments not been made. So a couple of examples, management fees on an investment portfolio or potentially maintenance fees on an investment property would be considered incremental expenses.
Okay, I think we've now covered the investing category. So let's move on to the category of income and expenses from integral associates and joint ventures. Now, we discussed the distinction between integral and non-integral associates and joint ventures and the reasons for that distinction in the first webinar. But could you give us a quick reminder of what is proposed again?
Absolutely. So the board is proposing for associates and joint ventures that are accounted for using the equity method, that investments in those entities and the earnings and the cash flows from them be separately presented between those that are determined to be integral and those that are determined to be non-integral. Now, the definitions of integral and non-integral are based on our definition of investing. So integral associates and joint ventures are those that do not generate returns individually and largely independently of the entity. In our statement of profit and loss that we saw the example briefly above, the income and expenses on the integral associates and joint ventures are included in a separate category outside of operating profit, but a subtotal is drawn that combines those income and expenses with the operating profit and loss. And I just want to clarify that income and expenses in the integral associates and joint ventures category isn't just the share of profit or loss arising from the equity accounting. It's also going to include any impairment losses recognized or reversed, and any gains or losses on disposal, for example, if it was a result of a step acquisition.
So does the board provide any guidance to help companies identify which of their associates and joint ventures would be integral and which ones would be non-integral?
It does. So along with the definitions of integral and non-integral, which will be included in IFRS 12, disclosure of interest in other entities, to help identify those entities that do not generate returns individually and largely independently, so those that don't meet the definition of investing, the board is proposing that the existence of a significant interdependency between the entity and the associate or joint venture would be an indicator of being integral. The board is also proposing some examples of what a significant interdependency would include, and those are things like having integrated lines of business, supplier or customer relationships, or sharing of a brand.
Now, before we move on to discuss the last category, so operating profit, could you remind us what's being proposed for taxes and discontinued operations?
Yes, that's a good point. So it's important to note that no changes are being proposed to the presentation of tax or discontinued operations. And to ensure that's the case, separate categories have been proposed for each to clearly separate them from the other categories.
So we've now clarified what goes into each of the categories of financing, investing, and integral associates and joint ventures. And just now, we've also confirmed that tax and discontinued operations remain unchanged. So it should now be easier to understand what's included in the operating category.
That's right. Because operating is defined as a default category, it comprises all the income and expenses that are not classified in the other categories. Defining operating category this way means it will include all of the income and expenses from the main business activities by including its financing, investing, and integral associates and joint ventures in other categories, but it will also capture anything else that results from the business carrying out its operations.
Now, in outreach before, we've heard that some stakeholders are actually asking for the board to define operating profit directly. And can you explain why the board is proposing to define it indirectly instead, so that's as a default or a residual category?
Yes, so as you said, the board was aware of such a demand from stakeholders. However, the board defined the operating category and consequently the operating profit indirectly because it works for more diverse business models, because it results in fewer debates about what does or does not meet such a definition. And such a result should achieve more consistency in application, making operating profit more comparable across entities. Also, in order for income and expenses to be classified, for all income and expenses to be classified, there needs to be a default category to capture those things that don't fit into another category. However, creating an additional non-operating or other category to achieve that would lead to more rather than fewer opportunities for diversity, particularly without having a specific objective. Therefore, the board is proposing to keep this as a default category, and having it that way is consistent of the view that the income and expenses that are generally incurred by the operation of the business are its operating.
Now, we spoke a bit in the first webinar about the modification to this model that we've just discussed for those situations when a company's main business activities are providing financing or investing, such as for a bank. Now, can you tell us more about how the proposals would work in those situations?
Of course. So as I mentioned earlier, the operating profit is designed to include the income and expenses from an entity's main business activities. But as you say, in some cases, an entity's main business activities might give rise to income and expenses that would meet the definitions of the financing or investing categories, which we've just talked about. So to address these cases, the board has proposed principles for when an entity would be required to move income and expenses from the financing and or the investing into the operating category based on when one of these are the entity's main business activities.
So you say that it depends on what are the entity's main business activities. Is there any guidance for companies to help them determine what are their main business activities?
So there isn't a definition of main business activities, but the exposure graph does provide some guidance. So if a business activity constitutes a reportable segment, that's an indicator that the business activity is a main business activity. The exposure graph also explains the types of entities the board had in mind when developing the requirements. It's also important to remember that this concept of main business activity only plays a role in assessing whether entities can move things from financing and investing categories into operating. It's not playing a role in defining what operating profit is in the general model, and that's because, as I explained, operating profit is the default category.
Okay, so let's first look at the items that can be moved from the financing category to the operating category. So if we look at the slide, that's the green arrow on the left. Can you explain what type of companies this would be applicable to?
Sure. So this only applies to companies that provide financing to customers as a main business activity. So for example, that would include entities such as banks or potentially car manufacturers that provide financing services to their customers. So for these types of entities, the difference between the interest revenue from that activity and the related interest expense would be an important indicator of the operating performance. So the related interest expense should be included in operating profit together with the interest income.
And then can you explain when items are moved up from investing to operating? So that's the gray arrow on the right-hand side.
Sure. So this is slightly different because the board wanted to make it clear that certain types of situations would be covered. So for example, an insurance entity, although investing might be seen as a key part of its business, it's not really the main purpose of the business, which would be to provide insurance. So for investing, it's income and expenses from investments made in the course of the entity's main business activities that are moved up.
Okay, so if we now look back at the green arrow again, so the financing arrow, would companies move up all the income and expenses from the financing category into operating profit?
So for the financing categories, entities would be required to make an accounting policy choice. So they would move either all income and expenses from financing activities and those from cash and cash equivalents into the operating category, or they would move only those related to providing financing to customers. So this option to move all of the income and expenses is provided because not all entities may be able to identify the portion of the income and expense that relates specifically to the provision of the financing to customers. Now, we can see this in the first example here, where we have a bank that invests as its main business activity, of course, as well as providing its financing to customers. Now, such a bank might not be able to identify which sources of financing financed its loans to customers separately from those that financed its other activities, so in this case, investing. So here the bank makes the accounting policy choice to include all the income and expenses from financing activities and the cash and equivalents in operating profit, and that's highlighted in green on the slide. Now, in this example, the bank does not show a subtotal profit before financing and income tax, and that's because there's nothing to be included in the financing category. And having a subtotal that says before financing when it includes financing would be misleading. Now, in this next example, we have a car manufacturer that has made the accounting policy choice to include only the expenses from the financing activities that fund the customer financing business in operating. That allows them to show the net interest income from their customer financing business as a subtotal within operating profit. And the income and expenses that relate to the funding of their manufacturing business remain included in the financing category. And again, that split can be seen here with the line items highlighted in green.
Now, in these examples, we can't see a line item for interest on defined benefit pension liabilities because we've assumed it's not material in these examples. But what would happen if they were material?
Yeah, that's right. So interest on other liabilities, such as pension liabilities, would remain in the financing category for all entities. So in both of these examples, if there was an interest expense on the pension liabilities, that would remain down in the financing category. And for the bank, that would be the only item that would be there. The bank, however, still wouldn't present a profit before financing and income tax subtotal.
Thanks. So let's now move on to discuss a subtotal which many users use in practice, which is EBITDA. However, EBITDA is not one of the three new subtotals. And Nick, can you explain why that is?
Yes, as you said, many users use this measure, but the board couldn't really identify an underlying concept for what EBITDA represents, other than it being a useful starting point for those users' various analyses. There was also many investors that did not think EBITDA was a useful measure. However, what the board has done is define a measure of operating profit before depreciation and amortization, and that would be a comparable measure that entities could voluntarily provide, and that would not be considered a management performance measure. Other EBITDA measures that an entity might provide that are defined differently than that would be included as a management performance measure.
And so the board is proposing to define operating profit before depreciation and amortization, which sounds very similar to EBITDA. Why didn't the board just use the label EBITDA for that new subtotal?
Sure. So the board did consider using the name EBITDA, but the content of operating profit before depreciation and amortization doesn't really match up with what the acronym EBITDA stands for. It also might imply that operating profit equals EBIT, and that's not the case. The subtotal profit before financing and income tax is a closer comparison to what is generally seen as EBIT. So the board decided not to use the label EBITDA to avoid any confusion.
Okay, so we've now covered all of the subtotals and the categories proposed in the exposure draft. So before we move on to take some questions, it might be helpful to talk a little bit about a couple of specific types of income and expenses that might be classified in all of these categories. And what I'm talking about is foreign exchange differences and gains and losses on derivatives. Now, Nick, could you tell us why the board is proposing specific guidance on these two topics?
Sure. Well, there's two challenges with foreign exchange differences. The first one is that they can arise on many different types of assets, liabilities, income, or expenses, and that means they could potentially meet the proposed definitions for any of the categories. The second is that entities tend to manage the risks of foreign exchange differences with derivatives or with other assets and liabilities, and that can raise questions about how to deal with a combined position.
So how is the board proposing to clarify in which category foreign exchange differences fit?
So to provide clarity on where such income and expenses should be classified, the board's proposing that the foreign exchange differences are classified in the same category as the income and expenses from the items that gave rise to the foreign exchange differences. So as we can see in this table, which would be applied to entities following the general model, the exchange differences on items that give rise to income and expenses classified in the financing category are also classified in the financing category. Those that arise from investing are included in investing, and so on. Now, this same principle would apply to entities with financing or investing as a main business activity, just that the relevant categories might be slightly different depending on what was moved into operating.
And so what about the second issue of risk management and derivatives?
Sure. So the second issue is a bit more complicated because it deals with two related issues, and that's derivatives and hedging. And both of these apply to more than just foreign exchange derivatives, and they both can be, but are not necessarily interrelated. So to deal with the various possibilities, the proposals can be summarized in this slightly complicated looking table, but actually they're relatively straightforward. So for derivatives, following the same principle as we just discussed with foreign exchange differences, the income and expenses on derivatives are classified in the same category affected by the risk it intends to manage. Now there's a few exceptions. So as in IFRS 9, grossing up would not be permitted, and in these cases, the gains or losses would be included in the investing category. For derivatives that are used for risk management that are not in formal hedging relationships, there's a cost relief for those situations when identifying the category would involve undue cost or effort. Again, in these cases, any gains or losses would be included in the investing category. And then finally, if a derivative is not being used to manage risk, it is classified in investing because that's the closest definition that it meets.
So that brings us to our last topic for today, which is the statement of cash flows. So as we said earlier, the scope of the project is really to only make targeted and limited improvements to the statement of cash flows. So the proposals here are pretty straightforward, aren't they?
That's right. So the objective of the proposals here is to get greater comparability by eliminating some of the presentation options that are currently available and lead to diversity in practice. So the first proposed change is a single starting point for the reconciliation in the indirect cash flow statement, and that starting point is proposed to be the operating profit. The other proposed changes are to eliminate the classification option for interest and dividends. So again, to eliminate what users tell us is unhelpful diversity of practice. The board is proposing that for most entities, the interest and dividends paid will be classified as financing, and the interest and dividends received classified as investing. Now, for those entities that have income and expenses from investing or financing to customers as a main business activity, as we discussed earlier, these proposals are adapted in a similar manner to avoid inconsistent classifications between the statement of profit or loss and the cash flow solely as a result of applying these proposals. In the next slide, we have an illustration of what a statement of cash flows applying the general model might look like.
Now, I see in this illustration that the labels of the three activities that you have in the cash flow statement are the same as those of the three categories we're introducing in the statement of profit or loss. So you've got operating, investing, and financing. Now, does this mean that the board intends to align the categories across the statement of profit or loss and the statement of cash flows or not?
So no, the board is not seeking to fully align these two statements. It appreciates that they have different objectives. So for example, if we look at the statement of profit or loss, the investing category aims to capture the results of the standalone investments. However, we look at the statement of cash flows, that same investing category aims to capture cash flows from investments in long-term assets that will generate future returns. So for example, cash flows from the acquisition and disposal of property, plant, and equipment are included in the investing category in the statement of cash flows, but depreciation on those assets would be included in the operating category in the statement of profit or loss.
So thank you very much for all of that, Nick. We've covered a lot of ground today on subtotals and categories, but we'd now like to spend some time answering participants' questions that we've been receiving. So Aida, I'll turn back over to you to introduce some of the questions we received.
Thank you so much, Colin. Thank you, Nick, for this thorough explanations, and thank you all of you participating today and for the questions you're sending us. We have quite a few questions we will try to address, but first I just want to give us a quick reminder here on the slide of the materials we have available relating to the project that are all on our website, including recordings of the previous webinars that are, gave overview of the proposals in the exposure draft as a whole, and we also have recordings of the same webinar in a number of different languages as well. And I just want to note that actually, whilst we are answering your questions, we also have some questions for you. So we have a quick poll of a few questions we would appreciate if you can take time to answer. So if my clicking has worked, you should hopefully see those questions on your screen now. And if you can answer them, and then I will try share results, summary of your responses at the end. So whilst you're doing that, let's take a look at some of the questions that we have received here. So the first question we have is relating to the operating category and classification of income and expenses there. And the question is the operating category intended for core business activities or all business activities? In other words, are supporting activities excluded from operating category? Karin, do you want to clarify this?
Yeah, sure. So the idea is that the operating category is intended to encompass all of an entity's operations, so it's not just its core business excluding supporting activities. So the idea was that the operating category should depict the entity's operations in a complete way. So the board thought that anything that's not investing or financing or from integral associates and joint ventures actually arises from an entity's operations. Now, I would like to note that the board does have other proposals to highlight things that have slightly different features. For example, if you have unusual items, you won't really be able to see that distinction being made on the face between what's usual and unusual, but we have a proposed note disclosure about unusual items, but we'll cover that in a future webinar. And also entities are able to add additional subtotals above the operating profit if they wish to do so, as long as it fits in the structure.
Thank you, Karin. So we have quite a few questions, so I'll just go through this. So we had a question about our analysis of the sample that was back on the slide 6 that was showing diversity in calculation of the operating profit, and the question was whether this was a sample from the same companies from the same industry, because it was clear that for example, a bank statement would be different from a retail or a manufacturer. So maybe I can just clarify this quickly. So in our analysis, we included a range of industries, but what we did in comparison is looking at some key items that you see in the examples there that users have also told us that they often find confusing because they find companies in the same industry presenting them differently, and this is exactly what we found in our sample. So we had, whilst we had different industries, we had companies from the same industries, and we found inconsistency in how operating profit is calculated. And just to clarify, clearly banks includes different items, just as you have seen it been proposed in the exposure draft. So when we counted the differences, we wouldn't consider things like interest expense being included in the operating for a bank and not being included by other companies. So with that, let's move on to next questions we had here, and this is about fair value changes recognized through P&L. So the question is, where would these fair value changes for investments classified as fair value through P&L be classified? Maybe Nick, do you want to take this one?
Sure, Aida. So fair value changes, I mean, the question is then worded in terms of investments, but fair value changes in general, we see, would it relate to the item in which that item is, the category in which that item is classified. So for investments, for example, fair value changes on investments would be included in the investing category. If, for example, there was something at fair value for some reason that was an operating, that would be an operating, and equally for financing. So the fair value changes depends on which category the underlying item is included in.
Thank you, Nick. And I'll go to the next question here, and I will maybe look at that myself. So the question is that there are investment items that meet the definition of cash equivalents, for example, time deposits that will mature within 3 months. And the question is, where would they be classified? So just to clarify, the board did not, the board thought the best way to approach this is to use the existing definition of cash and cash equivalents and classify everything that meets that definition into the financing category. So as Nick and Colleen explained, the idea is that this is used as a proxy for excess cash and therefore, you know, and seen as a good proxy to classify without causing undue burden for companies to kind of make another kind of split between items that are treated as financing as or investing. So let's look at the next question. I think, Nick, you already discussed this a little bit in presentation, but maybe just to clarify. So let me read the question. Which type of interest paid or received will then be part of operating activities versus financing activities? So, for example, financing elements in revenue arising from advance payment received and finance paid on deposits held in a bank, and also where would finance charges on leases be classified?
Sure. So we did talk about some of these items in the presentation, and I think similar to what I just mentioned about the fair value, the interest is going to depend on that underlying item. So there are probably few items in operating, but we talked about one potential on accounts receivable. Interest, of course, that would be related to financing, or the cash and equivalents that we talked about would be in that financing section. And if you had, for example, an investment in a bond that earned interest income, that would be in the investing section. So again, it sort of follows the category of what's the underlying item that's generating that interest.
Thank you, Nick. And just going down through the list of the questions. So we had a question, and maybe I will ask you this, Nick, as our in-house expert on associate and joint ventures. So the question is, paragraph 6 of the ED requires that the standard applies to entities preparing separate financial statements. And the question is, shall we conclude that entities that account for investments in subsidiaries, JVs, and associates at cost in their own separate financial statements should not present line item share of profit or loss of integral associates and joint ventures?
So the way that question's been asked, I'm not 100% sure what the exact issue is, but what I'll do is explain that the definition of the integral associates and joint ventures is key to that they are the equity accounted associates and joint ventures. So for those that are not equity accounted, this distinction between integral and non-integral is not required. Now, the bit of that question that gave me pause for thought is about the not being required to show the share of investments on associates and joint ventures. So those requirements remain, and I think the only distinction here is if in that standalone statements you had a different classification other than equity. So, for example, at cost, you would still need to classify the income and expenses relating to those in accordance with the rest of the proposals in the exposure draft. It's just that they would not meet the definition of the integral and non, and so that part of making that split would not be relevant. But there would still need to be a consideration of whether these are investments or part of operating, for example, depending on that assessment.
Yeah, thank you. Thank you very much for that, Nick. So let's look at the next question, and I'll take this one. So in your view, how does the concept of unusual items compare to the old guidance in IAS 8 of extraordinary items? And you know, it's been some years that this was in IFRS standards, but you know, it's vivid, I think, in many of our memories, the concept of extraordinary items. And we are going to talk about unusual items and proposals for disaggregation in the next webinar, but maybe useful just to touch on this here, because extraordinary item was something that was on face when it was part of IFRS standards. It was a separate category that was after profit, and it was post-tax, or it was presented on a post-tax basis. So it was quite a distinct category in a way that we now have discontinued operations, for example, category. So unusual is something quite different. It's merged together. It's embedded in the respective categories. So in that sense, it's a very different concept. But as I said, we will explain in more detail what the unusual proposal for unusual items trying to achieve in our next webinar. And let's look at the next question here, and maybe this one is for you, Karin. So the decision of what is the main business activity. So this is the question, and whether this has to be decided for each segment separately if you have a number of different segments.
So first of all, I would just like to stress that the only two sort of tests you need to do is whether you have the provision of financing as a main business activity or investing as a main business activity. So those are the only two things to check. And so I think you would assess that on a consolidated level. And so what we do say in the exposure draft is that, for example, if one of your segments is, for example, an investing segment, then that is an indicator that investing is a main business activity.
Thank you, Karin. And I am looking through, I can see we are kind of at the end of the time we said originally we will run this for, but there's more questions coming in. So what we will do is we will stay on and we'll try to answer as many questions as we can. Is, you know, probably take another 10-15 minutes. So let's look at the question on, there's a question clarifying Forex gains or losses. So the question is to confirm, are the Forex gains or losses on trade receivables and trade payables classified in operating? Maybe Nick, do you want to take this one?
Yes, so I think that's a fair assumption. So as I was explaining it, the foreign exchange gains and losses follow where the gains and losses on a particular underlying item would be classified. So as we talked about with an earlier question, interest on receivables being included in operating, likewise, the related foreign exchange differences would be included in the operating. Now, I think an assessment needs to be made. There are probably some exceptions, as I mentioned earlier on. We could end up with effectively borrowing from customers that result in interest expense that might be classified in the financing category. And so that if there were foreign exchange gains or losses there, equally they would be in that financing category. So we have to be careful not to say to be too prescriptive about definitely will always be accounts receivable and payable in operating, but I would say generally yes, that's the case, and just be aware of a couple of those exceptions.
Thank you, Nick, and maybe next one for you as well. And it's a quite long question here, but I'm just trying to read it. It's relating to cost of sales, and I think the participant has read the exposure draft proposals in paragraph 65, which are listing proposed minimum line items as requiring a separate line item for cost of sales, and that this requirement would apply to all companies, even those that present analysis of expenses by nature. So again, this kind of goes into the proposal for disaggregation and nature function, which we will cover in more detail. But given the, maybe useful just to clarify if the cost of sale is actually required, proposed required line item for all companies, Nick.
Yeah, I agree. I think that's a good one to try and clarify. And the intention certainly wasn't to make it a required item in all cases. In IS1 today, that cost of sales is a required item when a function of expense presentation is used. In fact, it's the only one, and it's been moved with the intention in that list with the intention to be the same. So it's only a requirement when a function of expense method is used, and there's a reference in the ED to that particular line item that's meant to clarify that. So we can maybe think about that, but it is, to be clear, only a required item in those cases where it's a function of expense method.
Okay, thank you, Nick. And we have a question relating to government grants and where would income from government grants be classified? Caroline, did you want to take this one?
I think in general it would probably go into the operating category. I can't see it meeting the definitions of investing or financing or integral associates and joint ventures. So I think that would be my assumption.
Thank you, Caroline. Yes, I would say so, and this really follows the proposals in the exposure draft where companies are meant to look at definitions of financing, investing, integral, plus the existing income taxes and discontinued operations, and then income and expenses that do not meet any of those definitions would by default be operating. And as Nick and Caroline explained, this is really consistent with the board's view that by default entities' activities are operating, and it's most appropriate to have these residual items, let's call them like that, as operating, rather than create additional categories that would perhaps not have a purpose on their own. So I'm just going through the rest of the questions, and we have another question about Forex, and the question is there a requirement to separate realized and unrealized foreign exchange differences within categories? And given you've been discussing Forex, Nick, do you want to take this one as well?
Sure. So the proposals for the treatment of the foreign exchange is really only about which categories they're classified within, and doesn't speak about how they need to be separated or which line item they need to be included in. So there's no specific guidance on that. I will say the one bit that the exposure draft does make clear is that if it justifies separate presentation as a line item, it would be the foreign exchange within each category would be presented within that category. But beyond that, the specific line items are not specified.
Thanks, Nick. And I think this is a related question again on Forex. This question is, do they have to be shown on gross basis in a particular category, or can they be netted?
So again, with all of the proposals, nothing has been changed in terms of the netting guidance, and so you would apply the same guidance that you would apply today in determining whether the net or the gross presentation is more appropriate.
Thank you, Nick. And we have a few more questions about integral, and one is our example shows dividends in the investing category, and the question is, why would dividends from integral associates and joint ventures be classified as investing if those are integral? Or actually, this might be the question around, because clearly dividends in the P&L, you would not present dividends from associates and joint ventures measured using equity method, because all you present in P&L is the share of profits or loss. So I think this question might actually be looking at proposals in statements of cash flows and asking why are dividends received from integral associates and joint ventures in the investing category in the statement of cash flows when this is not the case in the P&L. So that is inconsistent. Nick, do you want to comment on this one?
Sure. So as we explained,
or perhaps maybe I don't know. Maybe we lost Nick there for a moment. Maybe I can just clarify. Then, really, I think it's not consistent. That's right between the two statements. I think partly this is driven by the objective of the board's work in the statements of cash flows, and this is really to make targeted improvements and not Nick and Karin already explained why the board proposed separate category for integral associates and joint ventures in the P&L, and to do the same in the statement of cash flows would require creation of a new category, and this would be perhaps more significant change to the statement of cash flows than the board intended as a part of the project. And it's fair to say, I think overall in the statement of cash flows, we had a feedback that there is a demand for much greater review of that statement than what we have done in the scope of this project, and this is something the board will consider during the next agenda consultation, and it's quite possible if these proposals are finalized that this might be something that could be considered going forward. So I'm just looking at maybe just answer a couple of more questions, and then I will share the results of the survey with you, and then we can conclude. So I have a question. I'm not quite sure I understand it about EBITDA, but we can give some commentary. So the question is, when the measure operating profit depreciation before does not match the meaning of acronym EBITDA, where do you see the main differences? So perhaps this is explaining the difference between the acronym and the proposed subtotal. Maybe Karin, do you want to comment on this one?
Sure. So yeah, if this question is about why we in the end decided not to use the term EBITDA for that new subtotal that we're proposing, so there are a few differences, and they're a bit nuanced. But so first of all, operating profit before depreciation and amortization would exclude investing, and it would exclude the integral associates and joint ventures. So it would have to be earnings before financing, investing, integral associates and joint ventures, and D&A if we wanted to have an acronym for it. So it excludes more than just interest, tax, depreciation, and amortization. And then also EBITDA, it is earnings before interest, and so that implies that it's before all interest, whereas our measure of operating profit before depreciation and amortization is not actually before all interest. It's before probably most interest expenses, but in many cases interest income will actually be included in our measure of OPTA. So there are a few subtle differences like that.
Much, Karin. Let's take a final question, and it's acquisition-related costs for business combinations, and where also be costed, whether they would be operating or investing. Nick, maybe you want to take this one?
Sorry, Ida, could you repeat the question? You're cutting out there on me.
Okay, so the question is about acquisition-related costs of business combinations, and whether those would be classified as operating or investing activities.
So that's a fairly specific example, and I think given I think it's because the definition of investing is generating a return independently of the other assets of the entity, I find it difficult to see how that acquisition type of a cost would fall into that category. And so not meeting the definitions of the others, I think, as we talked about with being a default category, I think those would fall within the operating category if we look at it from that perspective.
Thank you so much, Nick. It seems that my connection is playing up a little bit. So what I would do now is I'm attempting to send results of survey to the audience. If my attempt does not work, I will ask Simon to maybe do that for me. So I hope you can all hear me still, and I hope you can see the results of the survey. Thank you so much. So we can see here that we have mostly preparers joining us, but we also have a wide range of other stakeholder groups represented. We don't have users, but we have quite intensive outreach with users through separate meetings. I currently cannot see myself the responses. I'm not sure if you can hear me. So I would suggest maybe rather than assuming that you can hear me and carrying on, I would just going to wrap up the session and thank you for your time. And I will look forward to our next webinar that will be on disaggregation and including discussion of nature function and unusual income and expenses. That will be in July at a date we're going to announce. So with that, I'll thank you so much again, and I'll close the session.